what is the definition of a security under the Securities and Exchange Act of 1933? The evolution of this really comes from a Supreme Court case, 1947, I think it's U.S. versus Howey, so if the question is the former, then that is what we call a joint venture, and that is not subject to SEC regulations.
So let's say somebody wanted to buy a property, like an apartment complex, without using any of their own money. What are the options that they have? Syndications, joint ventures, private lenders. What would you say those options are?
Yeah. So, I always say the number one rule of real estate investing is using other people's money. And other people's money can take many forms, right? Very many forms, like you just mentioned. I mean, it's even, it could be the seller in some instances, right? Creative financing techniques using seller's notes. The bank is obviously other people's money, right? That's not your money. You can use friends and family in a syndication structure, which we'll talk about in a little bit. You can use institutional partners in joint ventures, which is a separate sort of legal arrangement of how to purchase real estate. And you can even use strangers in certain circumstances. And that's another area of how to raise capital, using all these various methods so that you personally don't necessarily have to put in any dollars. Most of the time, and there's different schools of thought, but most of the time, lenders, though, will require whoever's guaranteeing the debt, whoever is signing on the dotted line and is the manager and in control, they'll usually require that you put in at least 10% of the required equity to buy a deal. Now, sometimes it has to come solely from the individual guarantor, and then sometimes it can be sort of the GP partners have to put that amount in. So you may not have to necessarily put it in yourself.
So let's jump into real estate syndications. What is a real estate syndication, and what's the difference between raising money via strangers versus family and friends?
Yeah, good question. So a real estate syndication is essentially a partnership between a sponsor who is the managing person who's responsible for acquiring the deal, executing the business plan, getting the loan, working with brokers, and making sure there's a successful exit, right? That's the sponsor. And limited partners, who are the money members of the company. They put in the money, and the sponsor puts in the sweat equity to execute the business plan. So it's a perfect marriage between two very important pieces of a partnership in order to execute a business plan and grow and scale the real estate portfolio. And the evolution of this really comes from a Supreme Court case, 1947, I think it's U.S. versus Howey, where the Supreme Court defined what an investment contract is. And I get questions all the time. Well, is this a syndication, right? Or is this a joint venture? And so what we're dealing with is, what is the definition of a security under the Securities and Exchange Act of 1933, right? That's the regulation that came down, or law rather, federal law that came down after the crash and the Great Depression of the late 20s, early 30s, where people were running wild and taking advantage of investors. And so the Supreme Court defined an investment contract essentially as, if you're giving somebody money and you are expecting a rate of return without putting in any, without managing or contributing to the management of those efforts, and you're relying solely on someone else's efforts to make that money, right, then that is the definition of a security under the Securities and Exchange Act of 1933. And so the first question I always ask when clients come to me and they want to use other people's money and they want to raise capital for a deal is, I say, well, look, are these people that you're getting money from, are they expecting to be active in the company? Are they going to participate in management decisions? Do they have other roles within the company that give them some sort of responsibility? Or are they purely passive and they're just giving money to you and you're going to go out and buy a building and make them 10 or 20% return? So if the question is the former, then that is what we call a joint venture. and that is not subject to SEC regulations, right? That is all handled within an operating agreement where we clearly define the members, we clearly define the roles. You and I are gonna go buy a building. I'll put in $100,000. You put in $100,000. We're gonna manage it together. That's not a syndication. That's not a securities issue. The securities issue is, and even if it's one person, I get this question all the time. Well, it's just one LP, right? Well, that the SEC does not define whether it has to be. Oh, if it's one, it's okay, right? If you give me your money and I go out and buy a building, and you say, hey, just mail me my checks every quarter and let me know when the property sells, that is going to be the definition of a security, and we need to comply with SEC regulations.
I love it. And then what's the difference between strangers and non-strangers?
Yeah,
How does that play a role?
Yeah, good question. So